to the channel, guys. I just wanted to cover off the new fund from YieldMax, YMAP or YMAG. So I just want to kind of talk about the strategy, the holdings, the risks, the crucial details for UK investors. So what is it? So it's the YieldMax Big Tech Option Income ETF, YMAP, provided by HanETF. And as I said, it offers an exceptional high forward dividend yield of 23.42% at the point of recording. It is domiciled in Ireland. And so how does YMAP generate its income? So it generates its income from a covered call strategy. It's actively managed, and the fund directly holds tech stocks and simultaneously sells call options on those stocks to generate immediate income, referred to as the premium. This creates a fundamental trade-off for the investor. Okay, so the ETF obviously holds tech stocks and then sells calls options. If the stock price rises, the fund's obviously potential gets capped based on that strike price. So that's the price that's agreed, and you get that premium up front. If the stock price falls, the fund is exposed to the full downside risk of the underlying stocks. So if we look at YMAP's key details and underlying holdings, so as I mentioned, YMAP is Irish domiciled, so it's UCITS ETF provided by HanETF, offering a tax-efficient structure for UK investors. It directly invests in a portfolio of tech stocks on which they write the cover call strategy on. It is a recent fund, so there is obviously a limited track record. It has an expense ratio of 0.99, so it is a little bit on the high side for typical European investors, but it does have genuine replication of the underlying, so it's a physical owning of the stock, not a synthetic. As I said, it's listed on the LSE under, confusingly, the ticker's YMAP, but the more confusing one, YMAG. Now, for the people that are familiar or maybe have watched some of the US YouTubers talk about YMAG, which is the YieldMax Magnificent 7, this isn't the equivalent. Why they've chosen that name, I don't know. Maybe to kind of preserve the name and hold on to it. But it is a little bit confusing because this isn't just the Magnificent 7. As you can see on the right-hand side, just the top 10 holdings just by weight. So if we look at it, Palantir, Netflix, MicroStrategy, ServiceNow, Intuit, Tesla, Broadcom, Coinbase, Microsoft, and International Business Machines Corp. And you can kind of see the average approximate weighting. So those are the 10 biggest holdings or top holdings within this fund. So as I mentioned, YMAP's got obviously a limited track record. It was only launched in March, and it has a very short operational history. This is critical when you're thinking about doing an investment. A lot of people have kind of been on that learning curve themselves with these high investments. However, where the data kind of drives and should be driving some of the decision making, and obviously giving it a bit of time for the fund to settle and understand where it actually sits. So obviously the availability performance data only covers a few months. So this isn't a good measure of how the fund's going to perform across different market cycles, like a bull, bear, sideways, over an extended period, etc. Obviously, the strategy itself hasn't been fully battle tested. Obviously, their cover call strategy has been around for decades, but we've never done it within this particular fund. We've never done it with this particular management before. So, as I said, there's no US equivalent of this directly. So we don't know how different market conditions are going to behave and how this fund is going to behave, because there isn't a natural comparison to be made. Now, obviously, the biggest risk with any of these cover call funds is, is there any return of capital? Obviously, with this fund being new, we don't know that, and we will track this over time. In fact, we have a dashboard where I'm tracking all of these cover call funds now, and YMAP has made the list. It's one that I've not personally invested in, but have quite keen interest in and looking towards potentially investing in the future. And I'll talk about why that is a little bit later on. So obviously another interesting kind of, again, this is obviously since inception, which has only been a few months, but since its recent launch, YMAP's kind of shown positive returns, but it also has experienced a notable peak and trough max drawdown. But this highlights the kind of volatility investors will typically endure from income generated actively managed strategies. So there's nothing probably that's greatly surprising there. The next thing I kind of want to touch on is how does it compare against its direct peers? So if we were to look at other covered call funds, and there is a draft of them coming out at the moment in the UK and Europe right now. I've deliberately left out the new funds from Rec Shares because, again, they're relatively new. But maybe in the future, I'll do a comparison of the YMAP against other funds like FEPI that's just been released from Rec Shares, because I know a lot of people are interested in that as well. So if we kind of look at the other kind of examples in the UK market, we've got Global X, QYLD, typically referred to as the grandfather of covered call ETFs globally, and then another one from JPMorgan, JEPG. Now, I picked these ones for comparison deliberately. So obviously they're all domiciled in Ireland, so they all benefit from the same tax benefits. Obviously, the inception dates are different for all of these funds. YMAP being the fairly new one, new kid on the block. As I say, QYLD's been around since 2022, and then we've got JEPG. So again, that's the island version of QYLD. By the way, obviously I know that the parent version's been around for a lot longer. So obviously with the YMAP, there's physical cover calls on the actual physical underlying the tech stock. The QYLD, I probably should have called it QYLP, but basically that's the UK version, which is writes synthetic cover calls on the Nasdaq. The parent fund actually writes on the physical stock as well. And then you've got JEPG, which is the actively managed physical cover call of the Global Equities Fund. Now, what's interesting is the expense ratios are vastly different. As I said, this one's the most expensive out of the pack at 0.99. And then we've got QYLD, which is 0.45, and then JPGs, which is even cheaper at 0.35. But what's interesting is the forward and current yields. So YieldMax is big tech is almost double that of the Nasdaq QYLD, which most of us have been used to having available to us, and it's almost 3 times that of the JPMorgan fund. So we're getting quite a decent amount of forward current yield. In terms of the underlying exposure, obviously the YieldMax big tech is the big tech exposure, big tech stocks that you'd expect, the Nvidias, the Teslas, the Microsofts, the Palantirs, etc. Nasdaq 100 again is known to be quite tech heavy and tech weighted. And then we've obviously got the global equity, which actually is a broad spectrum of low volatility focused, value focused stocks out there. Now, obviously, I'm going to look at this total return just to kind of give a flavor that obviously yield doesn't always translate to total returns. And actually, since inception, YMAP has returned around 10%. The Global X is 22%, and the JPMorgan's around 10%. I kind of want to break this down just so we can look at the annualized one, and obviously it's too early for the YMAP one. Global X is around 24%, and JEPG is around 9.68%. So we can see that actually, if this actually managed to maintain that forward yield and still gets decent returns, this could be a really, really good fund. Obviously, the max drawdown since inception, it's been around 13% for YMAP, 22% for QYLD, and JEPG is around 7-8%. So they've all got slightly different drawdowns there, depending on the exposure that they're exposed to. Obviously, as you'd expect, the lower yields typically lead to lower drawdown, and the higher yields are typically leading to higher drawdown. But what's interesting for me is that you'll notice the drawdown for YMAP is not as aggressive as it is for QYLD. Now, obviously, it's still early, but if they can maintain some kind of NAV and still return around 24%, then I think they're onto a winner, personally. Okay. Now, this just is a visual representation of obviously the total returns since inception. I thought I'd just try and visualize it. It's always nice to have these visuals. Another thing to kind of think about is the UK tax consideration. So obviously the UCITS and the reporting status matters. So for UK investors, the tax treatment of ETFs is heavily influenced by where they're domiciled and whether they hold UK reporting funding status with HMRC. It's obviously a crucial factor kind of impacting your net returns. So YMAP is Irish domiciled. It's generally more tax efficient for UK residents. Its income distributions are typically treated as dividend income, and therefore capital gains are subject to capital gains tax if the fund has that UK fund reporting status. Another thing is if a fund lacks UK fund reporting, also gains income and capital may be taxed as offshore income gains, as your marginal income tax rate up to 45%. So it's significantly higher than a CGT rates. But obviously check all this with HMRC and obviously speak to a financial and tax advisor. Another reason why it makes a difference is another thing about these funds are obviously you can hold them in tax advantage accounts such as an ISA and a SIPP, which can significantly boost your net returns. So if we look at it from an ISA perspective, which for UK investors is where they can get all their dividends and distributions from YMAP exempt from UK income tax. And then there's also the benefit of the tax-free capital gains. So any profits from selling YMAP, should you want to, within an ISA, is also free from capital gain tax. The other real big advantage is that there's no need to declare your ISA income or gains to HMRC. On the flip side, for a SIPP, you obviously get tax relief on your contribution, so receiving tax relief on your marginal rate, whether that be 20%, 40%, 45% on contributions, obviously boosting your investment up front. You've obviously got that tax-free growth vehicle in terms of the income and capital gains from YMAP are tax-free within the SIPP. And then even when you actually come to withdraw it, typically there's a 25% that can be taken as a tax-free in retirement with the remainder taxed as income. And obviously the SIPPs are generally outside of your estate for inheritance tax purposes as well. If we kind of look at UK alternatives just beyond the usual covered call, just to give you some examples of some other ones where actually you can see how there are other income vehicles out there, but nothing that returns even close to 24%. The highest one being around about 8 to 9%, but the standard being anywhere between sort of 4 and 8% there. So the conclusion is YMAP is YMAP right for you? So the thing to think about is it's good for experienced investors who fully understand options and their implications, those that want to prioritize that high current income over capital growth, accepting some potential NAV erosion, and investors with a high tolerance for the volatility and the clear understanding of the fund's kind of limited track record at the moment. So there you go, guys. That hopefully gives you an idea of the new YieldMax fund that just entered Europe. Let me know in the comments whether you're buying and what you think about the current fund and its strategy. Thanks a lot. I'll catch you on the next one.